Imagine paying the price of a house for a flower. Not a bouquet, not a garden, just a single tulip bulb. In the 1630s, this wasn't a joke or a metaphor. This actually happened. At the height of what's now called Tulip Mania, a rare bulb could sell for more than what skilled craftsmen earned in 10 years. There are records of people trading livestock, land, and entire estates just to get their hands on a particular tulip variety. And then almost overnight it collapsed, prices crashed, fortunes were wiped out. For centuries, this bizarre episode has been held up as one of history's first recorded financial bubbles, a cautionary tale of greed, speculation, and irrational market behavior. But here's the thing, almost everything you've heard about tulip mania might be wrong. Not just exaggerated, fundamentally misunderstood. Because while the story is often told like a fever dream of collective madness, the reality is far more interesting and far more relevant to how markets and people actually work. So what really happened in 17th century Holland? And what does it reveal about the deeper forces that still shape our financial world today? Let's unpack the flower-fueled frenzy that became a mirror for modern economics. To understand tulip mania, we first have to step into the world of the Dutch Golden Age, the early 1600s. At the time, the Netherlands was booming. The tiny republic, thrown off Spanish rule, built the most advanced navy in Europe and was establishing itself as a global trading powerhouse. The Dutch East India Company, the first publicly traded corporation, brought in spices, silk, and silver from Asia. Amsterdam's stock exchange was thriving. Banking and finance were more sophisticated here than anywhere else on Earth. And into this wealthy, cosmopolitan society came the tulip. Native to Central Asia, tulips first arrived in Europe via the Ottoman Empire. They quickly became a luxury item, exotic, colorful, and difficult to grow. But what really drove demand were the tulips infected with a virus, now known as the mosaic virus, which caused vivid flame-like streaks on the petals. These broken tulips couldn't be reliably bred and took years to mature. That combination, stunning appearance, rarity, and unpredictability, made them irresistible. Owning rare tulips became a status symbol among the Dutch elite. Displaying one in your garden was like parking a Lamborghini in your driveway. But soon, interest expanded beyond the aristocracy. Merchants, tradesmen, even artisans, people who had some savings or credit, began participating. And here's where things got interesting. Because tulips weren't just admired, they were traded. Initially, this meant growers and buyers making agreements during the off-season to deliver bulbs in the future, a kind of early futures contract. These deals were mostly informal and unregulated, often scrawled on scraps of paper in taverns. Prices started rising, slowly at first, but by 1636, speculation had taken hold. People weren't buying tulips to plant them. They were buying them to sell the contract at a profit before the bulb even left the ground. This abstracted the product from its physical reality. A bulb became a symbol of potential gain. And then in the winter of 1636 and 1637, prices skyrocketed. Records show that in some cases, bulbs changed hands multiple times in a single day. It wasn't uncommon for people to sell homes, livestock, or businesses to secure a single contract for a rare tulip. The most prized bulbs, like the legendary Semper Augustus, reportedly sold for amounts that would today equal hundreds of thousands of dollars. For a brief moment, it looked like the entire economy had gone floral. So how does this 17th century mechanism relate to us now? Because the patterns we see in tulip mania, speculation disconnected from intrinsic value, the rise of informal markets, and frenzied participation by everyday people, are not just echoes of history. They're happening now all around us. Think of cryptocurrency in the late 2010s. Like tulips, many digital tokens were hard to understand, difficult to value, and surrounded by hype. Prices were often driven less by utility than by perception and momentum. Suddenly, people were mortgaging homes to buy Bitcoin, launching meme coins overnight, and trading digital images of rocks for millions. Just like with tulips, ownership became a signal, a way of saying I was early or I get it. Or take the GameStop stock surge in early 2021. What started as a quirky Reddit trend exploded into a multi-billion-dollar tug-of-war between retail investors and hedge funds. Prices rose not because of corporate fundamentals, but because of collective sentiment and the belief that others would keep buying. Even the NFT boom mirrors tulip fever. Unique, scarce, often aesthetically driven items, frequently traded not for what they are, but for what they might become worth. Just like 1630s Holland, these modern bubbles weren't just about assets. They were about access, identity, and the thrill of outsized reward. People entered the market not just to grow wealth, but to belong to a story, a community, a movement, a moment. And just like back then, the crash, when it comes, tends to feel less like an economic correction and more like the end of a collective dream. But the story we usually hear about Tulip Mania misses something crucial. We tend to imagine it as a kind of mass hysteria, a nation of otherwise rational people suddenly overcome by flower fever, throwing money at bulbs like they'd lost their minds. It's often painted as a clear-cut morality tale. Greed leads to delusion, delusion leads to collapse. Simple. But when historians started looking closer, they found a different picture. One that doesn't just change how we see tulip mania, it challenges how we understand bubbles altogether. For starters, the idea that everyday people across the Netherlands went bankrupt chasing tulip fortunes, there's very little actual evidence of that. In fact, many of the most dramatic claims, like farmers trading entire fields for a single bulb or servants investing life savings, come from a single satirical pamphlet published years later, filled with caricatures meant to ridicule the upper class. It's like taking an Onion article as a historical source. What really happened was narrower and more strategic. The speculative trading mostly occurred within a small group of professional merchants, artisans, and wealthy burghers, people who already participated in high-risk markets. And critically, most tulip contracts were not legally enforceable. They were essentially informal bets, handshake agreements scribbled in taverns, not court-binding transactions. That meant that when prices crashed, many buyers simply walked away. They lost a deposit, not a house. This wasn't economic devastation. It was more like a speculative craze that burned hot then fizzled. No banks collapsed, no widespread defaults. In fact, the Dutch economy continued thriving after the mania ended. If this was a bubble, it was a soft landing, more of a psychological event than a systemic one. So why has the myth endured? Because the image of total madness is satisfying. It gives us a neat narrative: irrationality, punishment, moral clarity. But the reality, that speculative manias often operate in sophisticated markets, driven by calculated risk rather than pure emotion, is harder to swallow. It's not just about people being dumb, it's about how systems invite certain behaviors. Let's look closer at that system. Tulip speculation emerged in a market without central oversight. There were no standardized contracts, no clear regulations, no limit on how many times a bulb's ownership could be transferred in a single day. The lines between buyer and seller blurred. And because the contracts were based on future delivery, people could trade enormous volumes without ever touching the physical product. Sound familiar? This is the same basic architecture behind derivatives markets today. Futures, options, swaps, all of them involve promises, not physical assets. And like tulip contracts, their value can soar or collapse based entirely on sentiment, expectation, or perceived scarcity. It's not that markets cause bubbles. It's that certain market structures, decentralized, opaque, momentum-driven, make them more likely. The tulip market didn't explode because people were crazy. It exploded because the conditions made that kind of speculative loop possible. And those conditions haven't gone away. In fact, we've built entire financial systems on top of them. The 2008 financial crisis, fueled by complex mortgage derivatives most people didn't understand, sold and resold in markets with minimal transparency. The crash didn't start with irrationality. It started with a structure that encouraged traders to chase short-term gain while passing risk downstream. Even today, the lines between value, perception, and hype are increasingly blurry. A startup with no profit can be worth billions. A digital token with no function can surge because someone influential tweets about it. We're living in a world where belief often precedes substance, and where the tools to amplify that belief are more powerful than ever. Tulip Mania wasn't an isolated glitch. It was an early, elegant example of how even smart, well-functioning systems can be pushed into overdrive when speculation becomes the product. And yet, there's something else that often gets lost in the discussion. Tulips were never just flowers. They were culturally loaded objects, markers of taste, status, even national identity. At a time when the Dutch were building a new republic, asserting independence, and defining their place in the world, tulips symbolized beauty, order, and control over nature. To own a rare tulip wasn't just to speculate, it was to participate in a cultural story. This is where bubbles get their real power, not from charts or contracts, but from meaning. We don't chase assets, we chase the significance we attach to them. Whether it's a tulip, a tech stock, or a piece of digital art, the real engine isn't the thing itself. It's the narrative we build around it, the story that says, "This matters, this is the future, this will make you part of something bigger." That's why bubbles can form, even in rational societies. It's not mass delusion, it's collective storytelling. And stories, especially compelling, high-stakes ones, can become self-fulfilling. So what is the single, critical takeaway here? The core insight to distill down is simply this: financial bubbles don't arise from mass irrationality. They emerge when cultural meaning, speculation, and market structure align to create feedback loops too powerful to resist. They're not bugs in the system, they are the system running at full tilt. So let's go back to where we started. Why would someone pay the price of a house for a flower? Understanding that financial bubbles are built not just on greed, but on stories, systems, and meaning, we now see the answer isn't that people lost their minds. It's that the market made a certain kind of logic feel irresistible. When those conditions align, when a rare tulip becomes more than a plant, or a coin becomes more than code, price can decouple from value, and speculation becomes identity. And in that light, Tulip Mania wasn't an absurd historical blip, it was a preview. It foreshadowed how modern markets can be swept up in self-reinforcing momentum. How systems designed for trade can evolve into engines of narrative-fueled speculation. And how value, in the end, is always part numbers and part belief. That's the echo we live with today. Because in an age where trends go viral in hours, where information spreads faster than reflection, and where digital marketplaces never sleep, the mechanics of Tulip Mania have only grown more powerful. The bulbs may have changed, but the behaviors haven't. This doesn't mean markets are doomed to fail. It means we need to understand what drives them, not just the math, but the human impulse underneath. The desire to belong, to be early, to be right. And most of all, to find meaning in the things we choose to value. So next time a new asset class explodes into the spotlight, whether it's a cryptocurrency, a biotech stock, or a digital collectible, the real question isn't, is this another tulip? It's, what story are we telling ourselves this time? Because that story, not the flower, not the coin, not the company, is what gives it power. And maybe, just maybe, that's the part worth watching most closely. If you found this story as fascinating as we did, don't forget to hit that like button. It helps more people discover content like this. Subscribe for deep dives into the strange, surprising forces that shape our world. And drop a comment below. What modern trend do you think is today's tulip? Let's talk.